Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. Hello, everybody. It's John Brackett. We are getting ready for another great show. I have here a great guest, and his name is Ken Holman, someone who's been in the real estate world for quite some time, has done a lot of amazing things from developing to owning. And I'm going to share with you his bio here in a little bit so I can invite everybody into this great conversation. But one of the reasons why we have Ken on the show, other than his broad experiences, is he's contributed a lot in this industry just based on the various asset classes that he's been in. So we're going to talk a little bit about that. But, our purpose here is to build out great apartment communities, or communities for that matter, and improve how people live. Ken has been someone who's contributed to that purpose over the years. And so we're really excited to have him on the show. So Ken, welcome to the show.
Thanks, John. Hey, I noticed on your face you don't have as many wrinkles as I do. So that means you haven't been through quite as many wars as I have.
Well, I've had what I call a couple of expensive seminars in my day.
We all have.
I've learned to minimize them now, right? I've learned to find a way to minimize them. Well, Ken, we're really excited, extremely excited to have you on. So much, to talk about with you. I am going to introduce you to our audience. I'm going to invite them into this conversation, starting off with sharing your bio. So Ken Holman has had a long and distinguished career in real estate. He's obtained his real estate license in 1972 and his broker's license in 1975. Over the years...
I don't think you were even around then, were you, John?
Well, we're going to do more of these. When you come on and compliment me like that, I absolutely love it. And I feel young too, Ken, okay? I feel young too.
Oh, that's great.
You got your broker's license in 1975. You've done everything from brokering, from developing. You've built, right, construction, and you've owned over, $500 million in real estate, which has included everything from apartment buildings, condominiums, industrial properties, self-storage, office, hotels, and very interestingly, golf courses and retail properties. You've also been involved in fast food restaurants and other types of real estate properties as well. So presently, Ken, you manage, or you're a manager of several limited liability companies and also an investment partner with several other investors as well. So you're very active. You have several different companies that you oversee and are president of. And so I want to read those out just to give our audience some context as to how you're involved on a day-to-day basis inside the real estate business. So Overland Capital Corporation, you have Overland Construction Corporation, which you're the president of as well, Overland Development Company, Overland Group, Inc., Overland Management Corporation, of course, a property management company, Overland Realty Corp., which it seems like it's a DBA of, is it RE/MAX?
Well, it used to be RE/MAX. I owned a couple of RE/MAXes, but since then, what I've done is created a brand new brokerage firm that I really am excited about called Overland Advisors.
Okay, so I'm glad I asked.
Residential and commercial real estate.
Okay, beautiful. So I'm really glad I asked. I wasn't really sure how that was shown in here. And then also, Ken, you're active still with the National Association of Real Estate Advisors. So Ken, welcome to the show. We're going to have some conversation here today, and I'm really excited to get into a lot of what's going on in the marketplace. So, here's my first question, right? You've been in multiple asset classes. You've had the pleasure of going through various cycles, right? And when I use the word pleasure, that from the viewpoint of all the wisdoms gained that you can now not only apply to your business, but also advise your clients against that information and those experiences. So based on your long history of going through various cycles and investing in various asset classes, what class are you favoring in today's market? What are you really looking to pursue? Or what asset class do you like the most right now?
I've built more than 2,000 apartment units, and that's always been a favorite asset class for me. It bugs me a little bit because that's the name of your podcast, but I have to admit apartments are probably one of my favorite assets. And I think a big reason for that is if you do it right, they just have a steady appreciation in value throw off a good cash flow.
Sure.
And so that's probably what makes them my favorite. We do a lot of self-storage projects, and that's similar to apartments, but the ease of entry into self-storage is a lot easier than it is to get into larger apartment projects. So you find more competition, and you find that not only more competition, but more supply. So you have to be really careful when you're talking about self-storage that you're not getting in a market that's overbuilt.
Oversaturated.
Yeah, I like those. Another asset class I like a lot, which has fared really well, not only in this latest pandemic, but during the Great Recession, or whatever they called that, depression, not recession, I guess. The recession happened, 1929? I wasn't around then. But
I wasn't either, Ken. I wasn't either, okay?
Yeah, there you go. So I have really enjoyed the investment in retail projects that have national credit tenants. That's Dollar Tree, Dollar General, Family Dollar, Big Lots, Walgreens, CVS, O'Reilly Auto Parts, AutoZone.
Single tenant, triple net.
Single tenant, triple net. Those assets have done really well for us. And they're not quite as sexy, I think, as doing a cool apartment deal.
Sure.
But in terms of performance, if a market turns down, they just continue to perform well.
Okay, Ken, so I really appreciate you going through that. So I'm going to dissect some of that a little bit.
Yeah.
Because our audience, we have a fairly broad audience, right? So can you talk a little bit about what triple net means? Can you explain that? And then we're going to go into retail for a little bit.
Sure. Let me say, first of all, let's talk about national credit tenants.
Okay, let's do that.
Okay. National credit tenants are basically Fortune 500 companies that have extremely strong balance sheets, good cash reserves. They have the ability to weather the storms, and they tend to do, this is kind of an overused statement, but they tend to do good in good times and sometimes better in times that aren't as good.
Right.
Because they have a lot of consumer staples and things like that. A triple net lease, and these are not all triple net. Some are double net, some are triple net. And, you designate them by a double N or a triple capital N, depending on whether they're double net or triple net. But a double net lease means that the tenant basically takes care of all of the costs and expenses inside the building. And you as the landlord take care of anything outside the building.
Right.
The landscaping, the parking lot, the roof, those kind of things. A triple net lease is one where the tenant takes care of everything inside and out, pays the taxes. Both double net and triple net usually pay the property taxes and property insurance, but that's the difference. And we own both of those types of investments. And your triple net leases are generally going to go for a little lower lease rate than a double net lease, because you're not having to have any out-of-pocket expenses with those. So
Ken, one of the things that I just got into this conversation yesterday, I was underwriting and negotiating an opportunity to make an investment in an apartment building. This was about an 80-unit apartment building.
Yeah.
As a co-general partner. And
right.
One of the reasons why we weren't able to come to terms is we weren't really seeing eye to eye on how internal rate of return was being priced. I thought that it wasn't accurately reflective of rent and some other items in there, some expenses.
Yeah.
I thought it was really more like an 11 IRR versus a 16. And so my comment was, I don't think you're pricing this properly for a couple of reasons, but in the event that I now have to go in and spend my time, energy, and money to now bring this up, I don't think it's priced properly for that reason, right? So the reason why I bring up time, energy, and money is you talk about triple net leases and that being an asset class or a product rather that you favor, right? So can you talk a little bit about when you started that transition and how has that been on time, energy, and money, right? Because you've seen a lot of different product types that you've invested in. And so I always am curious, especially when I, have an opportunity to interact with folks that are much smarter than I am.
All right.
To really learn, right? Because the money is in the
that writing, and if you could send it to me, I'll send it to my wife. I think she'd like to know that.
Well, as soon as it gets to you, she can send it to my wife, okay? So when did you make that transition, and how do you evaluate the return on time, energy, and money at this point in your career?
Right. Even though I'm older, I've done well enough in my career that it's not about any one project, or it's not about getting a deal done tomorrow and making sure that I can earn a lot of cash so I be able to spend. So I always look on things from a longer term time horizon.
I really like that.
And I have sons in the business that are now stepping up and taking over some of the responsibilities, and even beginning to push me a little bit, which is kind of fun. So I don't have to look at things on a short-term time horizon, because I feel like my time now is just continuing to build a legacy.
Right.
So I feel pretty good about that. I'm in it for fun. So in terms of, let's talk about time and money a little bit.
Right.
That's the whole, I can see you coming out with different IRRs, because this guy apparently that was selling wasn't valuing all of the money that needed to go into the project. It sounds like you felt like you needed to put some more money into that deal to make it work and to make it pencil and to improve the rents, and he didn't. And that can have a significant input in terms of an IRR, because the more cash you invest up front and the longer you hold, the lower your IRR is going to be, right?
Of course.
Carrying it out over time. So I guess I got into the retail side of things. I've dabbled in it a time or two with some restaurants and stuff, which not all retail assets are created equal. Restaurants are a much higher risk.
Of course.
And so you should price those with a much higher cap rate than you do with these triple net projects, which are usually valued at a 6 or a 7 cap. Sometimes you get a Walgreens that goes down to a 5. But I got into it when we had this last downturn. And I thought, I want to start getting into an asset class that can weather the storm if we've had some economic ups and downs. And so we had an opportunity to team up with another partner that wanted us to build and develop several of these. And so we went out and built, I think, 8 or 9 of them.
Interesting.
Over a couple of year period. And those have done really extremely well for us. So
that's great. Now, I know, in this market, there's a lot of conversation around retail, of course, hospitality, and even in both product types. Now it sounds like you're at a point where you're shifting more towards the latter, right, which is the triple net product. With all of the conversation around the challenges that retail is going through in hospitality, do you feel that's still a good product to direct investment dollars into?
Well, on the retail side, the thing you have to be really careful of is a thing called the Amazon effect. And Amazon has killed a lot of retail. And bookstores, department stores, anything you can buy online, you don't need to have a building to, basically sell the product. And so I'm really careful to shy away from anything that's going to be impacted by the Amazon effect. When you get into projects that are more consumer staples and things that people need day to day, that's a little bit more impulse buying. And they're not going to get online to buy a carton of milk.
Of course.
So I like staying in the asset class that offers some consumer staples and things like that. So I'm very limited in the retail end, and I don't view it as long-term my best play. I view it a little bit like stocks and bonds. Everybody says diversify and have some growth stocks and other types of stocks, but they also say have some bonds, keep a part of your portfolio in that. I view these triple net lease products as kind of underpinning my whole overall return. So they're kind of the bond side of the real estate business. And then I view things like apartments as more the mainstay. And hotels, I think I have a little bit of a contrarian attitude toward hotels. They got nailed in this pandemic big time. And I don't know whether to sit back or jump in, because I think they're probably going to be suffering for another year or two. But I think there are going to be some opportunities out there. Once we get back to some sense of normality, then I think there's going to be some hotel operators that are going to have to liquidate assets.
I agree.
Because they've just had too much cash outlay. And I think there's going to be some opportunities there. So I'm kind of nosing around a little bit. I'm not getting too excited about it yet, but I see myself in 6 months probably putting together some hotel syndication stuff. So,
well, let me ask you some questions about that because I agree.
I thought this was an apartment show.
Well,
I'm just kidding.
well, Ken, here's the great thing that we're going to get into apartments, but with your background, as broad as it is, I think it's great because you can give a very different perspective than, many of our participants can. And so that's why I'm spending the time.
Oh, that's great. I'm just kidding with you.
No, I really appreciate it. And I just enjoy, these conversations, and they're great learning opportunities as well. But I do agree with you with the hotels that there will be some opportunities. But for you, as it relates to the hotel industry, okay, I mean, where do you see those opportunities, right? Because that can mean a lot of different things, inside of that space. Is it flagged? Is it branded?
Okay. So I am very cautious about anything I get into, because if you get into a bad product, you live with it for 10 or 15 or 20 years. It's miserable to get into a bad deal or have to dump it at a loss.
Right.
So the only types of hotels I really have any interest in are the branded flag hotels.
Right.
Marriott product, Hilton product, some IHG product. IHG's got Holiday Inn Express. They have a few brands like that are Staybridge that are good product types. So I want to be very careful when I get in. I'm not looking to buy some non-branded hotels.
Okay. I appreciate the feedback. So I'm going to transition now back to multifamily. Okay. So when you started off, I know you mentioned you built over 2,000 units.
Yeah.
What were some of the biggest lessons learned there, Ken, when you built out that product? I know some of it you sold, some of it you probably held for quite some time, and at some point sold, maybe you even still have a portfolio of that product. But what were some of the biggest takeaways there that you could share?
I guess it's from which perspective. If you're looking at it from the perspective of a new investor, it's hard to break into the apartment business because it takes a fair amount of cash to be able to do that. Today, we have the ability to raise a lot of equity capital on our deals. So the projects I'm looking at are, I guess a smaller one we're doing is 116 units in St. George, Utah. And then we're doing a 240 unit project in Mesa, Arizona. We're doing another somewhere between 250 and 300 unit project in Avondale, Arizona. So when I started out, everything I did was basically a 221 D4 loan, or that's a HUD type loan, where I could really amp the leverage up and keep the down payment low. Those take a long time to do, but you can get higher leverage on those type of investments, which keep your equity capital down. So I'm doing different deals today than I was back then. Most of the deals I do now are conventional type loans, and we can raise up to 15 or million on a deal. So we can get into some of those bigger projects. But which means I need to have you, John. You need to team up with me, buddy.
Well, we'll talk after the show. I'm always open to working with great people. Now, Ken, you mentioned that you're buying in different states. And to me, that's fascinating because not only are you buying in different states, but I mean, they're not small projects, right? These are 2, 3 projects.
Yes.
So not only are you buying in different states, you're raising capital for different states, maybe even raising capital in different states, which requires different security laws or requirements rather.
Right.
So what are you looking for right now in this market for investment, right? In that product type? What are some of the key things that you're looking for, considering all the speculation around uncertainty and where the market's going?
A couple things. One, we are in the buying mode. When this pandemic took off in March or April, when everybody was sitting home, I climbed on a plane and started flying around the country looking at assets, looking at property, saying, now may be a good time to buy if I can not get sick over this whole thing.
Sure.
So we put some projects under contract the last few months, which has been really exciting that we're working with. But I guess the best thing that I can say is I think we need to just keep going at what we're doing and working at to building more projects, because that seems to be our niche.
Is building.
Yeah. We love new construction.
Why do you prefer building over, buying a finished product that you can stabilize much quicker, or that may already be stabilized for that matter?
It depends. I think that, and I don't want to step on your toes at all, but if you're buying existing assets, there's a lot of players in that market. And I wouldn't say it's picked over, but it's getting more and more difficult to find good assets in there. I guess you'd probably concur with that.
I would agree with that.
And one of the positive things about doing new construction, the biggest negative is you got the development construction risk and the time it takes you to go through that and stabilize the product.
Right.
That's usually a 2 or 3 year process. So you have to be a little patient. But I think if you're doing that, the benefit of that is you're buying updated product and you're building updated product. So before, everything was 8-foot high ceilings. Now most of the product's 9-foot high, and the unit mixes are a little different. The demographic has changed some.
Sure.
And you're not buying a lot of economic obsolescence, if you know what I mean by.
Can you expand on that a little bit? So for our audience, when you talk about economic obsolescence, you're not talking about physical obsolescence, but rather economic obsolescence.
Yeah, there's 2 types of obsolescence: physical obsolescence and economic obsolescence. Physical obsolescence is everybody wants a 2-car garage and you're buying something that has a 1-car garage, and there's no way to expand it to 2 cars. Or everybody wants a 9-foot high ceiling and you're buying product that's got an 8-foot high ceiling.
Right.
And there's no way to raise the roof and get another foot on the ceiling. So that's physical obsolescence. Economic obsolescence is just being careful that you're buying in markets that
economic durability.
Yeah, but I had another thought. They have these thing called a life cycle of neighborhoods, where they build up, they grow, they stabilize, and then they begin to turn down, and they turn down for a while, and then something happens, generally on a government basis, where it sparks new development and they begin to come up again.
Sure.
Some cash infusion or something, a change in laws. And so economic obsolescence is you're buying in a market that is on its way down. And you have to be able to identify whether or not you're buying product in a market that's going down or a market that's going up.
So Ken, how are you and your team, what trends are you looking for to be able to make those decisions, right? I mean, what are you looking for to determine that, you're not purchasing into a product that is at some point going to be obsolescent economically?
Yeah, so some of the demographics that you look at, one of the most important ones is employment. You want to get in markets where the employment history is stable and growing, and it's not going down. And because that's what fuels new apartment development. That's what fuels people renting apartments, is having a good, solid employment base.
Sure.
And so that's why one of the reasons we're over in Arizona. Another reason we like some of those markets is the land is not overpriced and the product isn't overpriced. Whereas you get in some other markets, I won't name names, but get in some other markets that are overpriced. You just can't get the returns that you want to get. And that's where IRR is, it's all about that and cash flow. So we try to set our benchmark on IRRs at 20. Can't always achieve that, but that's what our goal is. Now that's for an apartment development. For retail development, you're going to be somewhere in the neighborhood of 12 to 15 IRR. So,
Ken, you mentioned something that really caught my ear, and that was, because of your experience in construction and now your product specific with construction, which is apartment buildings, you've had the opportunity of being able to see that product evolve over many years, right? In terms of use mix, in terms of demand for floor plan layout, fixtures, features.
Yes.
What are you seeing right now that you feel should be something that investors should be aware of in terms of changing trends with that product type? Because we have a very different market now, right? In terms of demographics, a very broad demographic base in some markets, and in other markets where you have high density, that demographic shifts to the extreme.
Yeah.
So what are your thoughts there?
2 or 3 things, I guess. There's this big change in millennials moving downtown.
Right.
And a lot of this product is built or, leased to rented to millennials. And with this pandemic, we've seen a shift out of the central business districts and the downtowns into more of a suburb situation. And we're starting to see millennials moving in that direction. That's why you're seeing a lot of home building, that these home builders are having trouble keeping up with the demand. And a lot of that product is people moving out of the central business districts.
I was always curious if that was true or if it was more of a myth driven by a lot of the fear in this market. But, you're a big builder, and so you're validating that, which I find really interesting.
Well, and you're seeing it in vacancy rates. Vacancy rates are going up in some of the major cities, and it's going down in some of the suburbs. That kind of gives an indication that there's some migration there to the suburbs.
Sure.
I'm seeing a little bit of that. The other thing that I'm seeing, I haven't done anything with this yet, but I'm really looking for some product type like this. I don't know if you've heard of the build to rent.
I sure have.
Have you?
Yeah.
Some people call it horizontal apartments, which I find to be a little bit baffling in terms of what they're really trying to say. But what it is basically is, depending on whether you're dealing with a millennial market or a market where you're dealing with seniors downsizing, depends on the product type there. Millennials, you can do townhomes, and you basically build a whole townhome community, and you don't sell any of them. You just rent them all. And they're getting some great returns on those. And I've seen the senior housing market, there's less interest now, it seems, to want to put mom and dad in an assisted living facility with all of the mortality that's happened with this pandemic.
Sure.
A lot of those people are just downsizing and moving into a small home, single family, single story, and they're built out in a community with an amenity package and a clubhouse and swimming pool, but they have a little bit of space and maybe a little yard, and that seems to be a really popular product type in certain markets. So,
what's really interesting, Ken, is I looked at a couple of those projects. In fact, when we're done with the show, I'll send you some of what I've looked at and considered, but it was more to understand the underwriting and the cost. I'll send some of my stuff over for you to take a look at. But the biggest thing that stood out to me there when I was looking at this, I mean, the yields, they weren't incredible, right? I thought that they were fair. But, you have a lot of institutional money chasing that. But what stood out to me was it almost appeared as most of the profits were being made in construction. When I looked at the cost to build relative to the cost of the land, man, there was a huge delta. And so that's institutional game, right?
That is totally.
It really is. So I go, I need to call up Ken and talk about partnering on the construction side.
All right, let's do that.
I'll send this over to you. I think you'll find it really fascinating, especially with you being a construction or a developer, but also someone who owns a construction company. But I know there's a lot of institutional money pursuing that space. And I see that the profits on the construction side appear very favorable.
Yeah, I think they are. That's why most of those products are developed and owned by construction companies.
Right. So, Ken, I'm going to shift back a little bit to just the conversation on how the multifamily product, right, how that product may start changing or evolving, especially if there's more of that product being built in suburban markets. So how are you anticipating that change? Because, it doesn't make sense building an urban product in a suburban market, especially if the demographic is moving out that way or shifting out that way. Because typically, when your demographic moves out in the suburbs, it also changes the complexity or the complexion rather of your tenant profile, right?
Right.
And whether that be folks that want larger units, different amenities, different features. Can you speak to that a little bit?
Yeah, well, obviously when you go suburb versus urban, you're getting into a lower profile product, usually 2 or 3 story garden style apartments, right?
Right.
Versus more mid-rise or high-rise. What we've done on the project we're building in Mesa is kind of hit a happy medium, and we actually are building a 4-story product there. I'm seeing a little bit of that because of the scarcity of land, that sometimes you can persuade the cities to let you go a little higher.
Right.
In terms of your unit mix, I haven't seen a big shift in that necessarily. The majority of your units are going to be 2 bedrooms with more 1s than 3s. And I see that being the same. I see that the unit layouts are being more open. People like to walk out balconies, something to create more of a overall feeling of the environment. I'm seeing an interest in a green, environmentally sensitive product where you're putting some solar panels. There isn't a lot you can do. You can try doing some smart home things, but I haven't been able to pencil those to get them cost effective, like, using your iPhone or whatever to regulate your thermostat or lock your doors if you're not home.
Right.
Some things like that. But I'm seeing a big shift in how you treat animals.
Interesting.
For years, apartment owners they don't particularly like animals because of the smells and the way they tend to beat up your apartment units. And that's showing a little bit of my personal bias maybe, but we've had to go just the opposite, because a lot of people now turn off half of your market if you weren't a pet-friendly community. And so you're building dog parks, you're building walk runs, things that...
That's just so fascinating to me that we've shifted to now roughly 50%, right? So when you say that, we would turn off 50% of our tenant base, right, if we don't accommodate for pets, I just find that fascinating. When I was a kid, my dad wouldn't even let, an animal on our yard.
Yeah, there you go.
I mean, he just, and God forbid it came into our house, right? I mean, that just
exactly
happened when I was growing up.
Yeah,
so the funny
not that way anymore.
My kids, we have pets. We have 2 little Multipoos. There we go.
Oh, okay.
Yeah. So they've been with us now for almost 9 years. I won the no battle for about 8 years. And then finally I showed up one day and I had 2 little dogs staring at me, bouncing around in our house.
Yeah.
Now they're just like family, right? And now I can understand how, as people, we can get so close to our pets, right? I get that now. I just couldn't imagine that growing up. I really could not.
That's a big deal. The other thing that's a big deal is outdoor activities. And so not only do you have to have a nice amenity package with like a fitness facility and things like that, so people have the ability to work out and swim and do some activities, but there's a lot of bicycles these days.
Right.
And so you have to focus on how are you going to make it so those people can deal with their bikes, and where do they store them, and how do you keep them safe? And there's some differences in the market than what it used to be.
Well, Ken, I'm going to pivot. I know we're getting close to the end of the show, but one of the things that I'm really curious to hear from you is talk about one of your expensive seminars. Something that over the years, I'm sure you've had a project that didn't go as planned, and why didn't it go as planned, and what was the greatest lesson learned, and how do you apply those lessons in your business dealings today, right, to prevent the same thing from happening?
Yeah, probably I think we all have made mistakes in this business if you've been in it long enough.
Right.
So the thing that I try to do these days is I try to get third-party opinions on every project I do so that it's not my emotions that are making the decision.
That's very
or
nice.
My, not knowing or knowing what the market is. So I always get an appraisal. Because our projects are pretty big, I always get a feasibility study from a good third-party company that knows what they're doing. And then I use that along with the knowledge that we glean from doing our own research to value the assets and how we're building them out. So that's basically what I do. If you want some war stories, most of those happened in the late 80s. And so it's beyond probably what most people do. But there was a period of time when the 1986 Tax Reform Act came on and the savings and loan industry tanked because of some of the policies that had been adopted by the government. It killed the S&L business. It killed the real estate business. And we basically had to completely regroup. Some of the bigger competitors out there to me didn't last because they were way over leveraged and had too much product. But we managed to weather those storms. And since then, I've tried to be pretty careful that I don't get myself into something that I can't perform on.
And also probably not a good idea to make a business out of passive losses, right?
Yeah, that's true. No kidding.
Oh, yeah. Man. Well, Kenneth, it's been truly an honor to have you on, and I really appreciate you sharing all your insights. It's been fantastic. And, I really appreciate you walking us through just the different product types that you've been involved in and why, and especially, in today's market, but also sharing with us just some of the trends that you're seeing as, a builder developer. I think that's very valuable because I always try to make it a point to focus on facts and not opinions, right? But when I'm talking to someone actually building out product in anticipation of shifts that they're seeing, then it helps validate some of the noise that I hear going out there, which now I guess really is not noise if you're building in anticipation of that. So I want to thank you. You've been a tremendous guest. Very honored to have you on. I look forward to having you back on. And how do people get a hold of you, Ken, to ask more questions and to learn more about your businesses and what you do? Sure. My personal email address is kholman, HOLMAN, at overlandcorp.com. That's OBERLANDCORP.com. You can reach me at 801-355-1111.
That's our primary number, and Kenzie can get you to me. So those are the two easiest ways. You can also reach me at investors@overlandcapitalcorp.com.
Okay, great. So we're going to add that to our show notes so that, that'll be in there. And of course, when we get that out, folks can have that as well. Ken, it's been truly an honor and a pleasure. It's been real. It's been fun. It's been real fun.
Yeah, great. Appreciate it. Thanks.
All right. Thank you. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.